we have some viewer mail.
We have viewer mail?
Yes,
I
we
like
do.
viewer mail. Please send your viewer mail to doug@riskandrewardtv.org. I'd be happy to answer your questions. What do we have this week?
This is from Jim in New York, and he writes, I hear a lot of talk about Warren Buffett's annual report, but almost no one owns the stock. So why does the media talk more about it than, say, Apple's report?
Yeah, of course. So, nobody talks about Apple's annual report. We talk about their products.
They talk about the numbers.
They talk
but
about the
not
numbers, but not really the annual
writing.
report. Right. So, his report has a lot of advantages over all the others. I'll give you three right off the top of my head. One, it's readable. Anybody can read the beginning of the report. It's not just columns and numbers. Secondly, it's honest. When he admits he makes mistakes, he tells you exactly how it is. He does it in language that everybody can understand. And third, it's insightful. He goes well beyond what you normally would see in an annual report from anyone and talks about broader issues such as the economy and so on and so forth. So we're going to take a look at one of these issues, but I just want to tell you that reading his annual report, especially for new investors or investors that aren't so sure about what's going on in the investment world, it's required homework. Every year you read it. And in fact, it would help you to read back through the past ones, and they're all online. So let's go through this one particular issue with it, the annual report, and you can start us off.
So he says, investing is often described as the process of laying out money now in the expectation of receiving more money in the future. At Berkshire, we take a more demanding approach, defining investing as a transfer to others of purchasing power now with the reasoned expectation of receiving more purchasing power after taxes have been paid on a nominal gains in the future. More succinctly, investing is foregoing consumption now in order to have the ability to consume more at a later date.
Exactly. So we've talked about that quite a bit, right? That's exactly what you do with stored work. We talk about stored work all the time.
Oh, yes.
We take our work, we store it away like, squirrels with nuts so we can talk about it later. So this is what he talks about with regard to investing, this is what we're trying to accomplish. So if I could take it from there, it says the next paragraph is, from our definition, there flows an important corollary. The riskiness of an investment is not measured by beta, a Wall Street term encompassing volatility and is used in measuring risk, but by rather probability, a reasoned probability of the investment causing its owner a loss of purchasing power over his contemplated holding period. Assets can fluctuate greatly in price and not be risky over the long haul, as they are reasonably certain to deliver increased purchasing power over their holding period. And, as we will see, non-fluctuating assets can be laden with individual risk. So when we think about this, so we're going to talk about the difference between stocks and bonds and owning real things and owning pieces of paper. What he's trying to get through is the bouncing up and down of the market doesn't matter if you're going to hold it for 30 years. So the easy thing for most people to understand is their house, they hold on to it for 30 years. If it goes up and down in price, it doesn't matter. The only price that matters is the day you sell.
That's true.
So the idea here is the bouncing up and down is what Wall Street considers volatility, and they consider that risk, the bouncing up and down. He doesn't consider that risk. He only considers it risks the day he's got to sell. And the day he's got to sell, then I want to know how much my return was and how much my purchasing power increased over that period of time.
Okay. He also says investments that are denominated in a given currency, including money market funds, bonds, mortgages, bank deposits, and other instruments, most of these currency-based investments are thought to be as safe. In truth, they are among the most dangerous of assets. Their beta may be zero, but their risk is huge.
Right. So they don't, a bond that is flat. You get the coupon every day or every 6 months, and then you get the money back. But the risk, if you have to sell before you get to the end, or like in Greece's case, even if you don't sell before the end, you might not get your money back at all. But the volatility is zero. It basically doesn't bounce around at all. So that doesn't mean that they're safe just because they don't bounce around. So I'll keep going here. Over the past century, these instruments have destroyed the purchasing power of investors in many countries, even as the holders continue to receive timely payments of interest and principal, a la the Greeks. And the ugly result, moreover, will forever recur. Governments determine the ultimate value of money, and the systemic forces will sometimes cause them to gravitate to policies and produce inflation. From time to time, such policies will spin out of control. Where does that
Imagine
ever
that.
happen again? Yeah. So,
The second major category of investments involves assets that will never produce anything, but that are purchased in the buyer's hopes that someone else who also knows of these assets will be forever unproductive, will pay more for them in the future. Tulips,
yeah.
of all things, briefly came into favor of such buyers in the 17th century.
Well, so we've talked about this a lot.
Yep.
So
Let
this
me
is the
in.
greater fool theory, right? So the first thing you do is you buy paper, and the paper assets don't bounce up and down as much, but you can lose money on them dramatically. Second thing is you buy something simply because you think it'll go up in value. That's not an investment, that's a trade. So to keep going on what he says on that, it says this type of investment requires an expanding pool of buyers who in turn are enticed because they believe the buying pool will expand still further. Owners are not inspired by what the asset itself can produce. It will remain lifeless forever, but rather by the belief that others will desire it even more avidly in the future. So here he goes on.
Cards, maybe?
Baseball cards,
or-
maybe, but what he's really talking about is gold. Because gold does nothing, it just sits there.
It's pretty though.
It's pretty. So the reason you'd buy gold is because you think in the future somebody else will pay you more for it. And so that's a reason you would buy gold. But in itself, it's just a lump of metal sitting there.
Okay, he goes on to say, our first two categories enjoy maximum popularity at peaks of fear. Terror over economic collapse drives individuals to currency-based assets, most particularly U.S. obligations. And fear of currency collapse fosters movement to sterile assets such as gold. We heard cash is king in the late 2008.
Just when.
Just when cash should have been deployed rather than held. Similarly, we heard cash is trash in the early 1980s, just when the fixed dollar investments were in their most attractive level in memory. Of those occasions, investors who required a supportive crowd paid for that comfort.
So the idea here is when the crowd goes all one way, they're usually wrong, and cash is trash in 1980. Well, if you bought 30-year bonds in 1980 at 17%, you would have done pretty well. Right? And now the 10-year bond is at 2%. And what are people doing? They're still getting into it. It's exactly the opposite. What they should have done in 2008 and what they should be doing now is getting out of treasury bonds. So that's the idea, is to go against the crowd because everybody's there. And finally he gets to the last one, and I'll just share this with you because I'm sure you know what it is. My own preference, as you know, and you know this was coming, is our third category, investment in productive assets, whether businesses, farms, or real estate. Ideally, these assets should have the ability in inflationary times to deliver output that will retain its purchasing power value while requiring a minimum level of new capital investment. Farms, real estate, and many other businesses such as Coca-Cola, IBM, and our own See's Candy meet that double-barreled test. Certain other companies, think of our regulated utilities, for example, fail because inflation places a heavy capital requirement on them. To earn more, their owners must invest even more. Even so, these investments will remain superior to non-productive currency-based assets. So what did he tell you? Don't buy paper-based assets because they're not going to hold long-term. Don't play the greater fool theory of buying something and hoping somebody else will pay more for it later. Buy productive assets, something that you can foresee increasing in value over time, that will continue to pay dividends. He owns a company that makes bricks. He owns a company that makes carpet. He owns a company that makes candy. He owns a company that makes, he owns Justin Boots, that he makes cowboy boots. These companies aren't going away because we're not going to get rid of cowboy boots. We're not going to get rid of ice cream.
Insurance, Geico.
Insurance, yeah, insurance is the greatest casino ever, right? So these are the things that he teaches you in this letter, and we paraphrased it to shorten it because it's even longer than that.
Oh, much longer.
Much longer than that. So this is your homework. This is what you should be reading. This is required reading if you really want to know what's going on in investing.
And do you have a takeaway for us?
I'm getting a little tired of talking, but okay, I'm going to do one more. So the takeaway is doing your homework is what allows you to be ready for the tests that you will most certainly face. Berkshire's report is every investor's homework. We may get different things out of it, but it's still required reading and annual homework. Don't not do your homework.